Welcome to TalkTickers. We're your shortcut to understanding the latest earnings calls.
That's right.
Today, we're jumping into Perion Network's Q1 2025 results. Just had their call.
Yep.
And, well, the headline seems pretty positive, doesn't it? They beat expectations, raised their outlook.
Absolutely. Beat on revenue, beat on adjusted EBITDA, and, raised guidance for the whole year. But I think the real story is underneath those numbers.
How they got there.
Exactly. How they're growing, what's driving it, and this big acquisition they just announced. It tells you a lot about where things might be heading.
Okay, good. Let's start with that snapshot then. Q1 2025. What were the big numbers?
So total revenue landed at $89.3 million.
Okay.
And adjusted EBITDA came in at $1.8 million.
And both of those were above what they'd guided for.
Yeah, both above the high end of their initial expectations. So,
Wow.
Operationally, a strong start to the year.
Right. And what was fueling that beat? Was it just everything doing well?
Not quite everything, actually. It was really concentrated in their key growth areas. Digital out-of-home, DOOH.
The digital screens, billboards.
Right. That grew, get this, 80% year over year.
Wow. 80%.
Huge. Connected TV, CTV, that was up 31%. And retail media, think ads on retailer websites, up 33%.
Okay, so really strong performance in those specific channels.
And importantly, they pointed out these growth rates were way ahead of the overall market growth in those same areas. So they're gaining share.
That's a good sign. And these areas, DOOH, CTV, retail media, they're becoming a bigger piece of the pie now.
Definitely. They now make up 31% of total revenue combined. It really shows that strategic shift they've been talking about, moving towards these higher growth segments, is, it seems to be working.
Right. It feels like validation for that strategy. Okay, so let's dig into that shift a bit more, because if those areas are growing so fast, something else must be shrinking.
Well, yeah, that's the other side of the coin. More, let's call them mature parts of the business, saw declines. Web revenue was down 28% compared to last year.
Okay.
And search revenue, that's a big change. It was 52% of their revenue a year ago. Now it's down to 22%.
That's a significant drop in search.
It is. That was a major headwind year over year. But management was key to point out that search revenue has actually been pretty stable for the last 3 quarters, right around $20 million per quarter.
Okay. So the year over year looks bad, but sequentially, maybe it's found a floor.
That seems to be the message, yeah. And they also said they expect web revenue to stabilize year over year starting next quarter in Q2.
Got it. So the older stuff might be leveling off while the new growth engines are really firing.
Exactly. Look at DOH. It went from 6% of revenue last year to 19% now. CTV from 5% to 12%. You can really see the business reshaping itself.
And presumably that shift helps margins too. Are these newer areas more profitable?
That's what the numbers suggest. Their contribution, excluding traffic acquisition costs margin, basically, their gross profit after paying for the ad inventory.
Right, the ex-TAC margin.
Yeah, that improves quite a bit. It hit 44% this quarter.
Up from
38% year ago. So a 6-point improvement.
That's pretty significant. Shows the leverage as the mix shifts.
It does. Now looking further down on a standard accounting basis, GAAP, they reported a net loss of $8.3 million.
Okay.
But if you look at their adjusted non-GAAP net income, which excludes certain items like stock compensation, maybe some integration costs, that was actually positive $5.4 million.
So still profitable on an adjusted basis, even with that big drop in search revenue contribution.
Right, which, they'd argue points to good cost control and operational efficiency.
Speaking of costs, they did mention taking steps there in Q1, didn't they?
They did. Some structural cost optimization, things like headcount reduction, tighter controls on expenses, making sales and marketing more efficient.
All part of that Perion 1 initiative.
Exactly. Aligning the cost base with this transformation towards being a more outcome-driven platform, trying to be more agile, more scalable.
And they said CMOs are responding well to that unified Perion 1 approach.
Yeah, they mentioned getting positive feedback, which is always good to hear.
Okay, shifting gears to the balance sheet. Still sitting on a lot of cash.
Oh yeah, very strong net cash position. Nearly $360 million as of March 31st.
Plenty of firepower then.
For sure. Although, interestingly, Q1 itself saw them use cash. About $7.1 million used in operations and negative $7.4 million in adjusted free cash flow.
Okay. Why was that?
They explained it was mainly timing. About $8 million in payments they expected in March actually came in just a few days later in April, just slipped across the quarter end.
Okay, so a temporary blip, not a trend.
That's what they indicated. They reaffirmed they expect full-year adjusted free cash flow to track pretty closely with their adjusted EBITDA guidance. So they seem confident in cash generation for the year.
And they're putting some of that cash to work buying back stock, right? A lot of it, actually.
Yeah, quite aggressively. They boosted their buyback program up to $125 million back in March.
Okay.
By the end of Q1, they'd already bought back almost 6 million shares for about $53 million.
Wow.
And then in Q2, they stepped it up even more with an accelerated share repurchase plan, an ASR. Bought back another 3 million plus shares for over $26 million just since the quarter ended.
That is aggressive. Sends a pretty strong signal that management thinks the stock is cheap.
You'd certainly interpret it that way, yeah. Confidence in the long-term value, especially with the changes they're making.
Okay, so that brings us to the really big news from the call, I think. This Greenbids acquisition announced just this morning.
Yeah, this feels like a major strategic move.
Tell us about Greenbids. What is it? Why is it important?
So Greenbids is described as this cutting-edge AI platform. Its whole focus is on custom bidding algorithms.
Okay.
Bidding where? Critically, within the walled gardens. Think YouTube, Facebook, Instagram, as well as working with the major DSPs like The Trade Desk and Google's DV360.
Right, the big closed platforms where most of the ad money goes.
Exactly. And Greenbid's pitch is that its AI helps advertisers cut down on wasted ad spend and, more importantly, drive better actual business outcomes in those really complex, often kind of opaque environments.
So AI optimization specifically for performance within the biggest digital ad platforms, that sounds potentially very valuable.
It really is. It massively expands Perion's potential market, their TAM.
Yeah.
Perion's been historically strong on the open web, maybe more brand-focused campaigns.
Right.
Greenbids pulls them right into the lower funnel performance advertising, driving sales, leads, and does it inside those walled gardens where, frankly, most of the digital ad dollars are spent today.
And that focus on performance, on outcomes, that feels very timely, doesn't it? Especially if the economy is a bit uncertain, advertisers want results they can measure.
Absolutely. Yeah, the timing seems pretty spot on. It aligns with that market shift towards performance-based campaigns.
What about the deal terms? How did they structure this?
It's an interesting structure, kind of de-risked up front. They paid $27.5 million in cash at closing.
Okay.
But then there's a $22.5 million earnout, paid in cash over 2 years, but it's based on Greenbids hitting performance targets.
Ah, performance-based.
Right. And there's also a $50 million retention package, cash and equity, over 3 years to keep key people around. So a good chunk of the potential payout depends on Greenbids delivering post-acquisition.
Smart. And what's the expected financial impact for Perion?
They expect it to add to adjusted EBITDA starting this year.
Right.
So accretive pretty quickly with some early synergies helping. But the big step up, the significant acceleration in revenue and EBITDA they're modeling, that's expected more from 2026 onwards.
Okay, why the lag? Is it integration taking time?
No, they said the tech integration is happening right now. It's more about scaling the business. Greenbids has been primarily focused on Europe. So while they have a pipeline, PERI needs to really invest over the next, say, 12, 18 months to build out a substantial customer base for Greenbids in the U.S. market, leveraging their existing sales force there. Penetrating those huge walled garden budgets at scale takes time and investment.
Right, building that U.S. presence. Did they give any standalone numbers for Greenbids from last year?
Just ballpark figures. They said low double-digit millions in revenue and low single-digit millions in EBITDA contribution for 2024 on its own.
Okay.
But they were pretty clear. They're merging sales teams, integrating tech immediately, and investing this year to scale it. So because of that investment and the synergies, they said breaking out Greenbids numbers going forward wouldn't really make sense or be that helpful.
Got it. So if you put it all together, you've got the strong organic growth in DOOH, CTV, retail media.
Yeah, the core growth engine's firing.
Plus this big strategic bet on Greenbids, pushing them into performance advertising within the walled gardens using AI.
It really does feel like they're trying to position themselves right in the sweet spot of where digital advertising is heading, aligning with advertiser demands for outcomes, especially in those key high-spend environments.
And Greenbids plugs right into that Perion One platform vision, adding AI smarts for those specific channels.
That's the idea. Enhancing Perion One, adding brand-specific KPI tracking, more data, all within the walled gardens. It connects all the pieces.
Okay. And all this good news, the Q1 beat, the organic growth, adding Greenbids led them to raise their guidance for the full year, 2025.
Yep, confidence is up. They bumped both revenue and adjusted EBITDA forecasts.
So a new revenue range for the year,
$430 million to $450 million.
Which is, what, about a 7% increase at the midpoint from their old guidance?
That's right. The old range was $400 to $420 million.
Okay, decent bump. And adjusted EBITDA.
That range is now $44 million to $46 million, up from $40 to $42 million previously. So a 10% increase at the midpoint there.
Nice. And they mentioned having a healthy pipeline supporting that raise.
Yeah, healthy pipeline cited is giving them confidence for the rest of the year.
But again, stressing that while green bids helps this year's numbers,
The real excitement, the significant impact they're planning for and investing towards is really 2026 and beyond as they scale it up, especially in the U.S.
which makes that earnout structure make even more sense.
Exactly, incentivizing that future growth.
Okay, so listening to all this, the strong Q1, the strategic shift, the green bids potential, especially that 2026 ramp-up idea, it does get you thinking about possibilities. Now, let me be crystal clear here. This is absolutely not financial advice.
Definitely not. Don't trade based on podcasts.
Please don't. This is purely an illustrative thought exercise based only on the narrative presented in this earnings call. But here's an outrageous but plausible trade idea stemming from it.
Okay, let's hear the hypothetical. Emphasis on hypothetical.
You could argue or hypothesize that the market right now is looking at the 2025 guidance bump from green bids and saying, okay, nice, but not huge. Maybe it's underappreciating the potential transformation come 2026. So, the outrageous but plausible idea. What if someone took a highly leveraged long position in Perion stock? The bet being that green bids will successfully crack those big U.S. walled garden performance budgets using its AI, leading to a much steeper ramp in revenue and profit in 2026 than the market is currently pricing in. The outrageous part is the high leverage, and assuming that aggressive penetration happens on schedule and isn't already factored in. The plausible part is the strategic rationale the tech fits a major market need.
A classic betting on future execution and market re-rating scenario.
Exactly. But again, purely hypothetical, not financial advice, just connecting the dots from their commentary.
Understood. High risk, high uncertainty.
For sure. Okay, so let's wrap this deep dive up. Key takeaways. Perion network, strong Q1 beat.
Yep. Driven by really impressive organic growth in those strategic areas. DOH, CTV, and retail media.
And they made a big strategic move acquiring green bids.
Potentially transformative, yeah. Pushes them hard into performance ads, AI optimization, and crucially, inside those walled gardens, opens up a much bigger market.
All leading to raised guidance for 2025, but with management really pointing towards 2026 for the bigger impact from green bids as they invest to scale it.
That's the summary. And remember, all this is based on their earnings call and materials.
And one last time, definitely not financial advice.
Definitely not.
So here's something maybe for you, the listener, to think about after hearing all this. Perion just made a very deliberate bet with green bids on AI-driven performance inside walled gardens. What does that signal for the rest of the ad tech world?
Interesting question.
Yeah, how do companies focus purely on the open web or maybe relying on older ad tech models compete or adapt? Does Perion's move tell us something fundamental about where the power and the money is consolidating in digital advertising long term?
A big strategic question for the whole industry to grapple with.
Definitely something to mull over. As always, do your own research, form your own conclusions. Thanks for joining us for this TalkTickers deep dive.
Thank you.